Live and Lansing with Michael Cohen. This is more compelling talk radio, 1320 WILS.
It is 6:21, and it is Tuesday night in Lansing, and we are live here on 1320 WILS. Thank you for joining us. When it comes to real estate, well, Realty Track recently conducted a survey of real estate investors and found that in 2012, a majority pursued the buy and hold investment strategy, although still a large number are flipping properties. So to talk about what's likely to work in 2013, and the environment we're facing now, I'm joined by Mark Bloom, the CEO of NetWorth Realty. He is a real estate expert. You can find him online at networthrealtyusa.com. Mark, thanks for joining us on WILS tonight.
My pleasure. Thanks for having me.
Okay, now, first of all, when someone talks to you about buying a house and flipping it, this coming year, does that sound like, do you think that's something that can really happen successfully on a large scale?
Well, when you say flipping it, I'm assuming you're referring to buying, fixing, and selling it. And I do think that depending on the market that you're investing in, it can easily happen. We operate in 7 different cities throughout the country. And in most of those cities, if not all of them, we've been able to sell investors' properties for the last 12 years, but especially over the last 5 years, where this downturn has been, sell them properties where they're able to buy them, fix them, sell them. Has the selling been tougher because of mortgages and fear, et cetera? In the recent past, sure, but there are still buyers out there, and there are still mortgages out there. But I believe, just like the article says, and just like you were hinting to, that the buy, fix, and rent strategy, I've always believed that that's a much better strategy given a one-off asset, looking at any house, any one particular house, if it cash flows, if there's equity in there, if it makes sense for you to hold, if it's profitable for the long term, if you're going to put the work in to fix that house, you're going to get more return from that house holding it for the long term than you are selling it immediately.
I see. So generally, that's the smarter way to go. Well, what kind of a house then are you looking for, or I guess condo for that matter, when you're looking to for an investment property of this kind?
Well, every investor is going to be a little different, and that's part of what we do at NetWorth Realty is we try and quantify what your risk tolerance is, what you want to do, what your goals are with investing, so you can figure out where and what you want to buy. I don't necessarily encourage condo buying, depending on the city that you're in, as much as I do single-family houses, because the real value of a home is in the dirt at the end of the day. That's the underlying asset that will make sure you never fully lose value. But you should be looking at houses that are going to rent for the national rule is about 1% of their value, where that 1% of its value is going to make sense versus the rental payment, in other words, or the mortgage payment. In other words, you're going to have cash flow. So a house, usually in the markets that we're in, it's going to be worth about $150,000, and you're going to be in that house for about 80% of whatever that value is. So $150,000, you'd be in the house at $120,000, and that house is going to rent for $1,500, and you're going to have a down payment on the $120,000, and your note's going to be probably $1,000. So there's positive cash flow there, and that's really what you're looking for is cash flow.
Mm-hmm. Now, how many homes should, especially if you're not a big-time investor and you have a full-time job, how many homes do you think you can really juggle?
As far as rehab process or owning and renting?
Owning and renting, and I guess adding to that group.
Okay, so as not a full-time investor, someone who's got a 9-to-5 job, but has some experience, this isn't their first house, okay? You can own realistically as many properties as your bank will allow you to, because once they're fixed and they are tenanted, you're going to put them with a management company who is going to handle that property for about 10% of the monthly rent, and they're going to continue to make sure that repairs get done. They check with you when they're above a certain amount. Otherwise, you've set that amount, and they go ahead and do them, so you don't have to be bothered with a $50 repair. And so it becomes that there is, just like any business, you get some economies of scale as you start to build. As far as rehabbing, if you have a 9-to-5 job, I would very honestly tell you that you're probably going to be able to rehab somewhere between 1 and 4 properties a year, 1 a quarter, because you're not having to sit them on the market and let them sell. So as soon as they're rehabbed, especially in today's market, one of the great things about being a landlord is there is a very low vacancy rate. So you're going to be able to rent your property relatively quickly.
And how much are banks willing to work with investors now, real estate investors, to let them expand their properties?
Of course. everything dependent upon the investor, creditworthiness and capital requirements. But given solid investors, I mean, we have banks that are, I'm almost reticent to say it, but we do have banks that have offered certain investors what we would call a no money down deal, where they're pledging stocks instead of a cash down payment. But most banks that we're seeing now that are coming out, they're going to lend to people whether they want to buy. So Fannie Mae cuts you off at 10 properties as an investor. Once you're above that 10 properties, you go to what's called a portfolio lender. That's basically just a bank with a lot of money that's going to hold that note. They're not going to sell it on the secondary market to Fannie or Freddie. And they're going to lend to you with 20% down, just like a traditional lender. It's just going to be a slightly higher interest rate than you would pay from Fannie or Freddie. And to give you an example, we're not talking about 10%. You can still get loans from a portfolio lender at somewhere between, depending on your credit again, somewhere between 4.5% and 6% on the high side. So
didn't real estate investors, even those that were renting properties, didn't they take just a horrible hit with this housing downturn that occurred? And how certain are you that won't happen again?
Well, you can never be certain. There's always a certain amount of risk in investing. That said, I can tell you that I owned property through that entire downturn, that I have not a ding on my credit. My credit is probably better now than it was when we went into it. And if you're a responsible investor, even in a downturn, as a buy, fix, and rent investor, it doesn't hurt you anywhere near as badly, because the value of that property matters at 2 points. Okay, when you buy it and when you sell it. What happens in between that, just like your stock account, is just for the day traders, okay, people who are selling. If you set it up as we talked about in the beginning, where there's cash flow, you have a fixed mortgage, your rent, it may fluctuate down in the down market a little bit, but it's not going to fluctuate down 40%. Rents don't move like that. People still need a place to live. If they can't buy, they're going to have to rent. Even if they don't have jobs or jobs are fewer, will rents come down? Yes, but they still need a place to live, so they're going to have to rent as long as your cash flow is there. Do
you still have many homes that are, in fact, worth less than the mortgage you're paying?
Myself personally?
Yeah.
I have probably at this point maybe one property that is worth, than the mortgage I'm paying, no, but worth less than what I paid for it when I originally bought it, which the property I'm referring to is in South Florida. It was a rough market, but even that is probably still back to, let's call it, water level. It's probably even. I don't have any equity, but I'm not losing money, and they all cash flow. That's why you hold them.
In terms of location, how smart is it then to spread the localities out? Is that the way to go, or should you kind of keep them where you yourself are?
Well, it's a double-edged sword, because our country, our world is becoming smaller and smaller. People are doing their jobs from wherever they want. Your real estate investing market is no longer necessarily your backyard. I like to spread out my real estate investments, but I also consider myself a fairly sophisticated or knowledgeable investor. I wouldn't tell someone who was a first-time buyer to go buy, not necessarily not in their backyard, but definitely not in a very risky market like an LA or a Miami or a Vegas. If you want to buy outside of your own market, for instance, one of the reasons I came to Texas from Florida was because it is an outrageously stable market. And they only lost maybe, on average 2% a year in the Dallas marketplace over that whole downturn, which is pretty significant compared to the rest of the country.
Can I ask you about how many properties do you own yourself right now?
I own about 15 properties myself right now as a real estate investor, but we, our business, NetWorth Realty, that's my personal investment portfolio. Our business, we probably close on somewhere in the neighborhood of 1,000 to 1,500 properties a year that we then turn over to other investors.
So give me a sense of it then quickly, in terms of how quickly you got to that number. How long did it take you to get up to this 15 properties?
The 15 properties. So I have been investing in real estate where I've been actually buying for probably 13 years, but I have only been buying and holding for probably the last 10 years. And those 3 years of not buying was kind of learning, or not holding, was kind of learning what I was doing, where I wanted to be, how I wanted to do it. But, I've been in this business for 15 years, and that's part of what we do at NetWorth Realty, is we try and impart the lessons that we've learned onto other investors to make their learning curve a little shorter.
Is he buying a house or two a year, essentially?
Yeah, and that's a good clip. If you can put away a couple of houses a year, And then as you get more comfortable with it and you get more, so you put those first few away, then you get some equity. You use that equity perhaps to go get leverage. Use that leverage to buy more houses, and so on and so forth.
Mark Bloom, CEO of NetWorth Realty. Find him online at networthrealtyusa.com. Mark, thanks so much for joining us this evening.
My pleasure. Thank you for having me.